That's great. Well, thanks for having me today. We're really excited to tell you a little bit more about Saturn Oil and Gas. So for those of you who are first-time viewers of this, we are an exploration and production company, an oil and gas production company based out of Canada. Currently, we are publicly traded. We trade on a few different stock exchanges, in addition to one in Germany, which I'll get into in more detail. We trade on the Toronto Stock Exchange on the venture side under the ticker SOIL. We're also on the Frankfurt Stock Exchange under the ticker SMKA. And most recently, we've expanded our public issuance here to the United States. So we've recently listed under the OTC market under the ticker OILSF. And that allows us to further contact and touch base with our US investors. So multiple different avenues to get in touch with us and to follow the company. So a little bit of background on Saturn itself. Currently, we are at production of approximately 12,500 barrels a day. That is quite significantly different than what we were a couple of years ago, and I'll get to that a little bit as well. Most recently, in the last 2 years, the company has grown from a couple hundred barrels a day, like I said, up to 12,500. And most recently, current present day production, we're actually exceeding about 13,000. So we have significant growth year over year. Currently, the Viking and OXBOW acquisitions, those are two of the most recent acquisitions that we have completed in the last year. And with those, it brought additional production base to the company. What that results to us is a year-over-year cash flow, low decline, light oil production base, and we have lots of room to grow. So over the last couple of years, we've grown approximately 5,365% production growth in just 20 months, and we'll get into guidance a little bit later. But what that equates to for our year-end 2023 is approximately $250 million in EBITDA, what we forecasted for 2023. And that's based on approximately a 96% oil cut. And with that, we have about 15 years of drilling inventory. So there's a little bit of difference between different companies, between whether you're an oil player or a gas player or a mixture thereof. And to us, what we like to do is focus strictly on oil, results in higher profitability and additional revenue stream to the company. So a little bit of background here on our strategy and our conservative management on our balance sheet and individual financials. If anybody has any questions on that later, I'll be happy to share. Currently, right now, we are forecasting net debt at the end of the year of approximately $215 million by 2022, with approximately $100 million by the end of 2023. And what we like to do as a strategy for a company as a whole, we present about 50% of our cash flow is directed towards capital drilling, and about 50% goes towards debt repayment. What that means to us on a total basis is we expect to be net debt free by approximately year-end 2024. So just between Q2, Q3 2024, at current prices, it allows us to achieve modest growth, approximately 13,400 barrels a day, up from current guidance of 12,500 barrels a day, and still realize full debt repayment by that period. A little bit of a comparison where we were a prior year. So Q2 2022, prior to our most recent acquisition, which is the Viking acquisition I'll touch on after this slide, we were about 7,000 barrels a day. With that acquisition, got us up to about 12,500. On the financial side, we have approximately 60 million shares outstanding with options and warrants of about 140 million. I'd just like to touch on this. We do have about $90 million of warrant proceeds that we're expecting to bring into the company about Q2 2023. So a little background and just an overview of the company itself. So currently we are 100% in Saskatchewan. So as you know, or you may not know, within Canada, it is very vast, very large land base. Most of the oil and gas production comes from 2 or 3 provinces on the west coast of Canada. Most notably, we are involved in Saskatchewan. We like Saskatchewan. That has the competitive advantage, I think, on a lot of fronts, especially on the royalty side. So The government is very favorable to oil and gas production. We have a very steady oil regime and a very steady royalty regime. What that equates to is, a lot of the other provinces, they have an annual review or a biannual review of royalty rates. And what that does, it just adds a level of uncertainty for future investment. With Saskatchewan, they have low royalty rates, a steady regime, and allows us additional predictability for future cash flows. So within the province itself, we have two main operating areas. We have the Viking asset and we have the OXBOW asset. So the OXBOW asset was an asset acquisition that the company completed in the second half of 2021. And the Viking asset was a recent acquisition we closed in the second half of 2022. A little bit about our company, just on a stand back basis. The reason we like Saskatchewan, we have over 100 employees at this company. We have long-term employees that have been with the company for 3-4 years. The company was recapitalized in 2017, and with that was a large resource base and also a large education base with the people that were actually involved in the asset. So they live there, they work there, they know a lot of the suppliers, they know the vendors. In fact, our chief development officer and our chief executive officer were part of a drilling company, and they drilled over 1,000 wells approximately in the province prior to coming over to Saturn. So with that, it gives us a great competitive advantage to move forward. So just touching base on one of the most recent acquisitions that we completed, which was very accretive and it increased our cash flow significantly. It was the Viking acquisition, which closed in July 2022. So with this, it was approximately 4,000 barrels a day of production. Again, in line with our strategy of keeping a high oil and liquids cut of approximately 98%. And that was made for a cash purchase price of approximately $240 million. Now, what that equates to on a metric was approximately 1.8 times cash flow, which means at current strip pricing, at the time that this was made, the asset could pay for itself in just under 2 years. So for us, it was a very attractive acquisition. With that, it had secondary additional accretion metrics. It reduced our royalty rates, it reduced our operating costs, and it came with a very reasonable stay flat capital expenditure production number, which I can get to a little bit later. On a per flowing basis, the production or the acquisition metrics was approximately 60,000 barrels a day or per day, $6,000 per BOE. And with that, we funded the acquisition with a $275 million financing, which was comprised of an expansion of our senior term loan with a New York-based family office. And we also completed a $75 million bought deal equity offering, which was actually issued at 65, and due to additional demand, it was upsized and oversubscribed for additional $10 million. So with that, the acquisition cost about $240. With the residual on those proceeds, we were able to put towards our capital plan, which went into our capital base, which is approximately $100 million. So just touching base on some of the specific acquisition metrics we have here. As you can see, post-acquisition, our production went up by about 50%. Our operating netback went up by 70%. Revenue, the first time the company has ever hit in its history, over $100 million in quarterly revenue, up from $70 million prior quarter. And what that equates to is adjusted EBITDA on a quarterly basis, about $50 million with adjusted funds flow, just there to see, with about 69 cents per share. So on a per share basis, our cash flow per share has gone up from about 45 cents to about 70 cents. With current strip pricing, we're looking close to $1 per share in Q4. In line with the acquisition, as part of our strategy as a whole, what we like to do is lock in the profitability. So as I know, even recently today, I'm sure many of you are watching the oil markets. The oil markets are very volatile. They can go up or down by the day. What we like to do is lock in the rate of return for ourselves and also for our investors, to guarantee that cash flow over years to come. So if you look on a bell curve, where we're actually able to lock in that production was front month June. So on a bell curve, that was the highest oil price that we've seen in recent history, and we were able to lock in some of those front month contracts. So what that equated to was approximately 2,700 barrels a day for the second half of 2022 at a US dollar price of approximately $102. 2,200 at 92, 1,600 at 80, about 1,000 at 72, and then the residual 3,000 on the back end at about $67 per barrel. And consistent with our strategy, what we like to do is lock in the hedging volumes on a declining basis. So for added clarity, what that results in is not a steady base of hedged volumes, but on a declining base, which the company then will drill out of. And in the event where oil prices increase in the future, we will then look to the bell curve and see if there's additional hedges to be added later on. So just a little bit of a further description here, just to add to how this asset fit with our current base. Everything in green that you see is current legacy asset lands, that Saturn held, and everything red were those lands that we acquired. So as you can see, it was very synergistic with our asset base. It allowed us to increase our netback, decrease costs. It came with about 10 years of additional drilling inventory. So it came with 138 booked location, and with the acquisition allowed us to expand our existing Viking asset base by a further 53. So like I said, about stay flat production of 4,500 BOE per day gives us approximately 10 years of drilling inventory. On a cash flow basis, what that results is free cash flow of about $100 million, or cash flow, sorry, about $100 million. Less maintenance capital of 40 results in annual free cash flow from this asset alone of projection of about $65 million per year. And on a yield basis, that equates to about a 27% free cash flow yield. So compared to our peers, that is close to the top, and we like to think that's doing pretty good. So a little bit on the reserves and the average type curve. So, for our public data that has been released, we've released the first 12 wells of the program. So as you can see, our actual type curve for the wells, we are exceeding that in most bases. So on a program level, we have exceeded or beat our type curve. We have about 35 to 40 wells planned per year going forward, which is about $100 million per year in capital expenditures split between the Southeast asset and the Viking asset. And what we like about the Viking asset is its predictability. They are very, very stable wells. We know the area. Our drillers understand it. You can actually get in there, and there's high decline rate. So when oil prices are high, you can produce them fast and realize that revenue in a short period of time. So a little bit on our second asset, our second core area is located within Southeast Saskatchewan, and that is what we call the OXBOW asset. So it's a little bit different. It's a bit of a mature field. When I say mature, I mean there's been oil and gas production there going on since the 50s. So what that does is it actually de-risks a lot of our drilling locations. We understand what's there. There's no exploration activity or minimal exploration activity, which actually aids the company. So this asset, it comes with 4 main different territories. So there's Mydale, Frobisher, Spearfish, Elida, and Tilston. With those comes with slightly different type curves, but all within structure. One thing that this asset came with, which I like to touch on, is the infrastructure. So, when you produce oil and gas, it's easy to drill and produce and set it on a truck. But one thing that's a key differentiator for Saturn is the ability to have its own pipeline network. So all in all, we have about 2,500 kilometers of pipeline, and it came with 54 key facilities. So Saturn is not only to process and transport its own commodity, what we're also able to do is expand that and realize third-party processing revenue from other vendors who want to use our infrastructure. So we make, like I said, we make about additional $5 million right at the top every year, just with third-party processing. And again, going through the reserve base here, the acquisition currently, or the asset, sorry, has about 300 booked locations at the end of last year. The reserve engineers are going through that right now, and that will be updated in due course. We had 22 horizontal wells drilled in the OXBOW since Q4 2021, and as you can see, those IP30s were about 70 barrels a day for the first 18 wells, which was in line with guidance and slightly above type curve. So the recycle ratio on those is slightly better at 4.2, and the well payout is about 6 to 8 months, which is in line with the Viking as well, which results in a return on investment of about 325%. So for every well we drill, we can drill it and get our money back in approximately 6 to 8 months, in which time we can take that money, put it back in the drill bit, and that reserves on the recycle ratio. And giving you a little bit of history, you know, one of our VPs, he does this sometimes, and he likes to call this the Canadian hockey stick. And we just like to give a little bit of history of the company itself and where we were and where we are and where we would like to go with our annual target growth rates. So as you can see, you know, back in Q1 2021, we were 200 barrels a day, about 233. Slight change just due to drilling activity, but the real jump really happened in 2021 when we completed the OXBOW acquisition, and that bumped us up to about that 7,000 barrel a day mark. Still a junior player. Now with this secondary acquisition, gets us up to 12,500. You know, we've shown we can perform on the acquisition front. This year is our first year with a capital budget in excess what will serve to be approximately $100 million, probably close to 80 or 90. With that, we have a target 14% annual organic growth rate, which results in 13,400 next year. Back in 2017, the company was recapitalized. So we had a new management team that was able to come in with experience in the area, and throughout the years, through acquisitions and additional drilling activity, we're serving to be an intermediate player in the Canadian gas market. Pro forma 2022 guidance. Just like to go through this briefly. So right now for 2023, we like to put a modest growth rate on it. I don't think, you know, internally the market's not rewarding extreme growth, but the market is rewarding modest growth. So that's what we like to go to. Our current base assumptions for 2022 had year-end $95 oil, and at 2023 at US $90 oil. What that will result in is about 13,400 barrels a day of production, with pre-hedged EBITDA of 319 million, or post-hedged EBITDA of 250 million. And a little presentation here, just a comparison with some of our peer group. So we like to show this slide. You know, one of our differentiation strategies here is an oil weighting, and with that you can see we're approximately 96% there on operating netback compared to our peers. Because of that, that results in an extreme beneficial operating netback. So too, with the price of oil, our profitability increases. And just on a trading metric, our 2023 EV debt adjusted cash flow, you know, your average base here for your average company is about 2, and we're trading around 1.5 times depending on the day. So from a valuation perspective, we see Saturn as a very attractive investment mechanism. And just on the corporate guidance as well, you know, we've done an extensive search here, and we've met with the analysts and truly trying to get our name out there. And I think that's one of the main reasons for the valuation. In the last year or so, we've added additional 5 coverage houses to have independent analyst research on Saturn, and we have a target price in the range of about $7 to $7.50, and that's cumulative amongst all the individual houses here. We have 4. This is listing 5 and 6. Most recently, we've picked up coverage from Paradigm Capital and also First Berlin, based in Germany, for all our German investors. So that's kind of a brief overview of what I've had planned for our presentation here. And I was told I have 20 minutes, and I think I hit that right on the button. So with that, I'll open it up to any questions you may have.
Yes, thank you, Scott. Yeah, there are already a couple of questions in the chat, but you're also welcome to post more. So the first one is, the Canadian or US competitors are trading at 3 or 5 times the cash flow. Compared to the US, these also pay out dividends or buy back the shares. When does Saturn start buying back shares or announce that they will try to trade at 3 to 5 times the annual cash flow?
Yeah, so on a trading metric, I think for us internally, what we like to do, and this goes part and parcel with your secondary question, at the time being, our strategy is to repay debt. Once our debt leaves manageable levels, that increases optionality to further expansion plans. Now we don't have any set plans, to be clear, to issue any dividends or stock buybacks at the moment, until our debt level reaches manageable levels of, under 0.5, under 0.25 sort of thing. So that's kind of a strategy in Canada. In Canada, they've actually come out with some new tax laws and new tax regulation, which is not so beneficial to do stock buybacks. So that's another hindrance of some companies that you will see. So we hope to be, based on current analyst guidance right now, they have a 1 to 2 year price target of $7.50, and that would get you in that 2 to 3 times cash flow multiple. Once you start getting to 3 to 4, you're a bit of the outlier. So, that could be an expectation, but just to increase on average base about 2 times, I would say within about a year or 2, that's our goal.
And a price cap of $60 for Russian oil has been set by the EU. What are your expectations on how this will affect the WTI price? And secondly, how will it affect the revenues of Saturn Oil?
Yeah, and that's a good question. And I think that's part and parcel of a larger conversation. Oil markets are fairly volatile. So when we look at the industry as a whole, we see over the course of the last 3 or 4 years, there's been constant underinvestment in the oil and gas space, not just in Canada, but throughout the entire world, with additional restrictions, lockdowns on COVID. Within the last week, I think, there was additional uncertainty with opening the borders or opening the availability to people within China on the COVID front. There's some expectations there. There's the $60 price cap for US dollars on oil, in addition to the issue with tankers as well, and the availability of tankers and the ability to insure the tankers, which is the real crux of the issue. For us right now, we always look at that as possible volatility, which we try to mitigate through our hedging strategy. So while that will impact Saturn to an extent, right now we're currently about 75% hedged, and we have hedged those volumes in the future. Its impact will be minimized compared to a lot of our peers. Now, on that point specifically, I think everybody has an opinion. My personal opinion is, I think what's going to happen is, it may have short-term price impacts, but I really think what's going to happen is just going to redraw the distribution channels. So currently, rather than delivery points to Europe, for example, I think you're going to see revised expectations from maybe African oil coming to Europe, and then the Russian oil potentially being on tankers and shipped to countries that aren't privy to this cap, countries like India and China.
And a different question from another attendee. Does Saturn have any plans to add brine, lithium, or helium, or any other fuels to your portfolio?
At this time, we're a pure play oil company. So, with adding additional commodities, it's a different engineering base, it's a different asset base. At this time, we're strictly focused at oil and gas. Yes.
Mm-hmm. And how many wells are currently in operation?
We currently have about 1,700 operated wells. And for as far as scheduled to be abandoned on that front, I'll take a moment to talk about our ESG strategy. Currently, Saturn has a very robust asset retirement obligation program. With this, we have made a commitment to be stewards not only to the land, but to the people that own the land. So we've made partnerships with all the farmers that we drill on. We actually drill on a very small subset of their otherwise land that would be used for farming opportunities. So things like wheat and grain, we will actually go and lease that small section from the farmers. And with that, we will perform our asset retirement obligation on those lands, down to whole abandonment, reclaim the wells, and put them down. Currently this year, we've abandoned close to 140. So with that, this year alone, we have about $14 million in asset retirement obligation costs that both the company has paid out of cash flow. In addition, we received support from the Saskatchewan government. Again, a little shout out to the government there and the favorable treatment, where we were able to apply and receive grants for additional costs to put down in the ground. So next year we have in the budget approximately $5 million to put towards retirement obligations again. And the way the current royalty or the current retirement structure is displayed, you have a mandatory spend within 3 years. Thereafter, it is renewed. So we do have the mandatory spend built into our budget, and with the optionality to go over and above that if we see value there.
And in terms of numbers, how many wells do you plan to abandon next year?
About 100 or 200. It'll really depend on the structure. So it'll depend on if it's a surface reclamation or a downhole abandonment. So the way it works with an asset retirement obligation is we don't have a 1 year development plan to actually remediate it. What you do is you remediate the well, and then you wait for the year, and then you remediate the surface, and then you wait a year, and then you get the government regulation certificate for clearance. So you really have about a 2 year window where you reclaim. So you're constantly doing year over year. So between the 2 years, I would say 200 to 400.
Okay. So we have a minute left. Maybe just one last question. At what WTI level is the company at break even, including loan repayment and maintenance capex for flat production?
Yeah, and break even for it'll depend if you do a break even analysis with capital included. Excluding capital, that's why we've structured the company with our hedge book. So with our hedge book, about $40, I would say US dollars is our break even.
All right. So about 10 seconds left. I think that's not enough for another question. Thank you very much, Scott.
That's great. Thanks for having me.